What is something that might seem small but can take a big bite out of your returns over time? The expense ratio. Think of an expense ratio like a maintenance fee for your apartment building. You may not see the staff working every day, but you are paying for the upkeep regardless. With investments, the expense ratio is what you pay the people managing your money even when you're not noticing them work. In simple terms, an expense ratio is the annual fee that funds charge from their investors. It's expressed as a percentage of your investment. Let's break this down with a simple example. If you invest 10,000 rupees in a mutual fund with an expense ratio of 1%, you will pay 100 rupees in fees each year. Now, if you think that you can avoid this annual cost by selling the fund just before 1 year mark, let me tell you that won't happen. The management company will take the cost out of the fund's net asset value daily behind the scenes, so it will be virtually invisible to you. If you're wondering what's included in this fee, everything from the fund manager's salary to administrative costs, marketing expenses, and sometimes even the cost of running those fancy TV ads you see. So what is a good expense ratio for a mutual fund? A good expense ratio depends on the investment goals, risk tolerance, and other individual factors of the investor. But remember, when it comes to expense ratios, lower is almost always better. Every rupee you don't pay in fees is a rupee that stays in your investment account working for you year after year. Here's a pro tip as well. Two funds might seem identical, but if one charges significantly less than the other, that difference compounds dramatically over time. It's like two taxi drivers taking the same route to your destination, but one charging much less for the ride. Remember that different mutual funds have different expense ratios. For example, passive funds typically have much lower expense ratios, often below 0.2%, because they simply track a market index instead of having managers actively picking stocks. Active funds, where managers try to beat the market, generally charge 0.5% and 2%. So next time you're choosing investments, don't just look at returns. Check those expense ratios too. Your future self will thank you.